This is the R in Real Estate.
Thank you for joining in for another episode of our podcast. I am Asia with Asia Realty by Moline Group Broker CEO, and this is the R in Real Estate podcast. Thank you again for joining me. Our today R is roadmap to home ownership. So thank you so much. I have an amazing partner. We have had the opportunity to get so many hundreds of people into homes. And I want to introduce to you the roadmap to home ownership with Miss Fleda Paul of Diamond Residential.
Oh, thank you for having me today. My name is Fleda Paul, and I am the branch manager at Diamond Residential Mortgage. And I've been in the business over 30 years, and I'm very passionate about helping individuals go through the home buying process. I'm very passionate about that. I help clients come from.
No, you good. Yeah, you good. You good.
Okay.
Yes.
So, again, let me just kind of start over. My name is Fleda Paul, and I'm with Diamond Residential Mortgage, branch manager in Fayetteville, Georgia. And I've been doing this for over 30 years. I'm very passionate about helping individuals get into a home and the home buying process. So, get ready with some of the questions that you may have for me.
Yes, so yes, this podcast is for us to be able to speak, of course, but this podcast is for us to be able to inform our community, help more and many of us, and be educated with this whole process of home ownership, on the real estate realm. But definitely we want to be able to give you the opportunity so you can get some information, transparent information, but some real information when it comes to real estate with each and every one of our episodes. So yes, we'll dive in.
Okay.
What would you say would be considered the first time, like the steps, the first time home buyers, what you need to do before applying for a mortgage? Just some steps for any of the first time home buyers that's listening.
Well, as far as first-time home buyers, the first step is to kind of know your status as far as your credit status. We're looking at maybe 3 or 4 different factors when you're purchasing a home, and that's income, that's credit, and your job stability, and your assets. How much assets do you have? So we can actually tackle each one of those steps. If you're a first-time home buyer and you don't have a lot of money for your down payment, maybe you get down payment assistance. You can get some assistance there. If you have credit concerns, we may be able to assist you with your credit concerns, see where you are, see if there's any blemishes on your credit, maybe guide you through that process. As far as income, usually we want you to be on your job for at least 2 years. Okay. If you're not on your job for 2 years and you've been working or you've been in college, then we can use your college education as part of your income. So that's for your job history. If you're looking for down payment assistance, we just kind of look and see how many people are in your household. If you can if that's the area that you need the money, then we can see if we can find some money for you.
Good. As far as preparing, what do you think for us in preparing financially?
So I wouldn't say as far as purchasing a home and preparing financially, it's the same as renting.
Okay.
It's very similar. I mean, usually they're looking at for rent, they're looking at 2 to 3 times of your income versus if in purchase, there's a little bit more flexibility. So with that being said, I just say, qualify. If you have a good job, if you've been on your job, a stable job, I wouldn't say a good job because any job can be considered a good job depending on your income. Okay. However, if you have job stability, you've been on your job, or you just got out of school and you've just been offered a good position, then I would say try. And your credit is decent, then there's always, I would say start with qualifying first as far as filling out an application and see where you are. Because you can't really guess. A lot of times people want to guess and say, I can't really qualify. Right. And next thing you know, they're in a house because they only, basically information and knowledge. So we give you that information and we give you that knowledge about home buying.
Absolutely. And don't be afraid too, because I know a lot of times people be thinking about credit, right?
Yes.
But there's something that can be overcome it, meaning that, because I know you all before, like a stimulator to know where
Mm-hmm.
person is with credit, things, different tips of different things that can boost the credit.
Yes.
Too.
So I can give you some different tips on from what I'm seeing, because we do have a system that allows us to evaluate the credit.
Right.
And when I say evaluate the credit, you may start off with a 620, and there may be opportunity to get you up to like a 660. So with those being, what I've been seeing as far as getting the credit up is basically how you're utilizing your credit. So your credit cards utilization, you may have to bring down some utilization of your credit cards. If you're up to the limit, that's automatically going to bring your score down.
Okay.
So you want to be at least 25 to 30% utilization, and then you're looking at medical bills. Actually, medical bills are usually not covered any longer. They're not included in that score any longer.
Medical bills not included in the credit score.
Yes, that's a biggie, because that was really hurting a lot of individuals' credit. As long as, and also regards to, like, say, student loans, individuals with student loans, know your status on your student loans. Go to the U.S. Department of Education, find out what the status is. Some of them are not in repayment. If you are in repayment and you're on a plan, and if that plan is more than zero, we can use that plan amount, or depending on the amount of the student loans, we'll take 0.5% of what your total student loans are, and we'll use that as payment. So we look at both ways to find out which is the best option for you. Now, depending on if it's a FHA loan or a conventional loan, and we'll go through those different loan programs probably in another episode. But depending on the loan program, you may be able to use a zero if your student loans is a zero repayment. We may be able to use that zero. Only if it's a conventional type loan. If it's a FHA loan, zero is not allowed. We have to use either the 0.5% or the payment, whichever one is the lower of the two.
Okay, so and with the credit, I know we said about credit and student loans, right? What if a student loan is in deferment?
So if a student loan is in deferment, we have to go a proposed amount. So a deferment is actually stating that it's on hold. So when it being on hold, if your student loans are deferred, we're going to use half of that amount that's owed. So if the total amount is owed is $100,000, then we're going to use a $500 payment.
Got it. Okay. Okay. So that's okay. So with the deferment, okay. So half a point.
Half a point, 0.5%. So, and then also I've seen on just on different credit reports, there may be several student loans.
Okay.
Then you want to go to the U.S. Department of Education and maybe inquire about consolidating. So consolidating is going to probably lower your interest on it, and also probably offer you a lower payment, because each individual student loan has to be calculated as a 0.5%. So you may be able to lose, better interest if you combine them together and just have one payment.
Okay. Okay, makes sense. So definitely there is a lot of opportunity with home buying, because I know when I'm doing consultations or when I'm talking about it, they either saying, I don't know my credit not, and then they don't even know. And sometimes get with you and the credit was good and decent all along, right?
Yes.
And then, or they say, because I know we had somebody that had like $200,000 in student loans, right? So it's all about just being able to have a consultation, having a plan in place, because a lot of times we don't know. We assume and can still actually buy and purchase a home.
Right. So, and then also what I do too is, so that initial evaluation is very important. So I ask a lot of questions. I evaluate the credit. There may be, let's say, for example, you may have a car loan, and the car loan is joint with a father, and they're making the payments, but it's on your credit. Then we can exclude that if it's been over 12 months, and we can show proof that it's being paid by the co-borrower or someone other than yourself. If it's on your loan, and let's say, for example, your father is making your payment, but it's still on your credit, we still have to use it because it's in your name only. So, but if it's a joint, yes. So, but if it's joint, and we can show proof that it's joint and it's in someone else's name along with your name, then we can exclude it if it's been over 12 months.
Okay, but if it's in that person's name
Uh-huh.
and the father is making the payment,
Right.
that person is still responsible because
Correct.
it is a joint. Gotcha.
Yes,
Okay.
yes, that's a biggie. And then also we've seen Asia where we looked at a person and they need to qualify, and let's say we give them options. Say, hey, see if you can get your car refinanced. You've been in it for a year or two, and your rate is 9%. I know that they have your credit is decent. I know someone has 2.3% interest on different credit unions and things of that sort. Refinance it, lower the payment so you can qualify for a little bit more house.
Makes sense. So yes, definitely. And then how would you determine how much someone can afford? Because I know a lot of times some of my people are shopping and they see the perfect house, right? And like before seeing, the house that you thinking you in love with, but just knowing where you are to buy.
Right. So what we do is we look at your income and all your liabilities as far as on your credit report. And so that is considered like your debt to income ratio. So there's a threshold. So there's a percentage of your gross income that we can use for your home and also with your liabilities all together. So there's a front ratio, meaning your gross income divided by a certain amount, and as far as what you can qualify on the front end. But then there's your housing along with your debt. So we want to make sure that you don't exceed that. And on paper, you may qualify for a certain amount, but when I have a conversation, you may say, hey, I've only been paying $1,500 in rent. And to go from $1,500 rent to maybe $2,500 in rent, even though you qualify on paper, it may be a shock. It may be a shock to you. So I always ask you, how much do you want to pay in rent? How much do you feel comfortable? Because you still have to live afterwards. And so they may say $1,800. So then, even though they qualify for that $2,500 paper on $2,500 payment on paper, I will go back and say, hey, with $1,800, this is where you are. You're at a certain amount as far as rent. So we having that conversation. If you have that conversation up front and you show them numbers up front, it's gonna, with the realtor, you're not gonna have to shop them, or they're not going to back out of that contract, because now they already know what they qualify for, and they're looking at homes based on what they qualify.
Absolutely. And then
they're giving them some cushion.
Right. And I tell my agents too, want to kind of go under that amount, because then it still makes it comfortable.
Right.
We can have some flexibility, because of course some of our counties taxes are more than others, or rather not. It was a homeowner with homestead, or a lot of corporations own a lot of the homes here in Georgia, so the taxes tend to be higher.
Yes, especially that first year. And also I tell people you have to live beyond the house. So when you're in the home and you're thinking that that's it, I got a fixed rate, I have a fixed rate mortgage and my mortgage is never going to go up. No. As your home is appreciating, your taxes will go up, and that is going to be taxed on you. So your lender will pay it, but they're going to in turn turn around and collect that money from you at the next year.
Yeah.
So just be prepared for that. Always hear that. Yeah, through the escrow.
I know I have some homes for sale based upon, because taxes, of course, I would say really across the world, we had the price hike where a lot of the home values increase. However, with that, I would say a lot of them like, my mortgage, but if it appreciated, that's really still good. Yes. Exactly. That's a real good thing. Maybe some don't want it with the payment, so I tell them to adjust some things with your insurance and things that work for you. But I know the principal interest is gonna be the same. But yeah, we had some good values appreciated. So and that's equity.
So what? And then when I have a conversation with someone individual with that as well, say, hey, if you in that situation, let's refinance you to a conventional. If you think you have 20% worth of equity in your home now, and you can not escrow, and you can say, I want to put that money in, and I tell individuals to set up a 401k or IRA, not a 401k, sorry, an IRA, individual IRA, and put that money in that account every year or every month, and you actually know your principal interest payment will not go up. So your taxes and insurance can come out of that account every year. You just will be responsible for it. So when you get to that point, you graduate to that,
Mm-hmm.
then I teach you how to do that as well.
I need to do an IRA.
Yes.
Yeah, because I'm paying.
You don't have? Okay,
Yeah,
so
I'm
we
paying
talk
my
after.
taxes.
Talk.
Yeah.
We have
Definitely.
to talk
So I told
afterwards.
y'all when I'm having these podcasts, it's learning things that you
Yes.
can go back and apply. So absolutely. What are the common types of loans? Or I know I'm saying first time buyers, but we got a lot of second, third, fourth.
Yes.
But what are the most common loan types?
So the common loan types, there's conventional loan types, which is considered, if you hear Fannie Mae or Freddie Mac, that is considered a conventional loan product. Or you have an FHA loan product, which is a government product, is FHA.
Okay.
So each one of the products, and they have VA. VA is 100%. And if you're a service member and you qualify for VA, that's an excellent product. And or a USDA if you're in the rural areas. And when I say rural doesn't mean Timbuktu. It could be Palmetto. It could be Hampton.
That's the country.
Yeah, not necessarily. It might be right on the edge. You have some areas in Jonesboro or Clayton County or Hampton that qualify for USDA homes. And that's 100% financing as well. The great thing about a USDA home, you can qualify and roll in some of your closing costs. So that's a great program to have. If the home appraised for more, then you can take the price. You can take a little bit of that extra appreciation and roll it in and help with your closing costs. So it could be a true 100% program for USDA.
What determines USDA?
It determines by the zip code and the address. So there is a link if you Google USDA home eligibility, and it gives you like the address. You just type in the address and see if it qualifies for it. Yeah,
and we'll put that in the chat and on the podcast as well.
Yes,
for USDA, because back in the day they used to say, well, anywhere you see a farm in the area.
Yes, but not necessarily. Yeah,
right.
We do a lot of USDA, especially in. Like I do a lot in Ware County, that area, Brunswick, Georgia. It's a growing area. Some areas in Jackson could be. So it doesn't. I wouldn't necessarily say that they're in, rural farm areas.
Oh yeah, I have a property listed in Jackson on Jackson Lake. So I need to check to see, because there can be a push too that if it can go USDA.
Yeah.
So that's really good. We have Jackson County, Jackson, Georgia.
Yeah.
Absolutely. So yes. Now we're navigating, because I know a lot of people talk about or need help with closing costs.
Okay.
So when you're navigating and thinking about down payment. What is your suggestion, or how, like, the process with down payment?
Down payment. So I would utilize, so that goes back to that initial review of that client. So you can see not everybody need it, but if you need it and it's there, then utilize it, because that's what it's there for. So as far as because some of the down payment assistance companies, they do charge a fee. So it's not just totally free money. There's a cost for the funds. However, if you're looking, also get the seller to contribute some of the funds. If possible, you can possibly increase the price of the house. And basically, you're just kind of financing in some of your closing costs. That's a way that you can finance in some of your closing costs. It's by using some of that funds. If the house is like 130, if it will support a 134, price, add 4,000 to it to see if you can finance in some of that closing costs. Or you can use some down payment assistance depending on the area, depending on the county, depending on how many people in your household. Is basically how some of the down payment assistance programs work.
Okay, because I know you all have done a great job with these down payment assistance, because I know we do have a lot of essential workers, our educators, police officers, healthcare field. So, and I know a lot of times, of course, it's great demand for their job type, but they may be at a way where they providing but don't have a lot of money saved up.
Correct. So that's one of the ways that we do. And basically, if you know a cost worksheet up front, just kind of know what that cost would be, they can know. And some of the individuals may dip into their 401k if they already have a 401k. You can dip into your 401k to do that, and then you can do it as a hardship. They'll allow you to do a hardship, one-time hardship, if you're purchasing a house. So that may be a way as well. We also, a gift from a relative. An employer can give a gift. Different charities can give gifts as well.
Oh, awesome. See, I learned something else. Employees can give, employers
can give employees gifts.
Yeah. So yeah, that's a great thing to have to retain some good people.
Right.
Offering that. So yeah, that's great. Now with the down payment, because I know a lot of questions comes because people looking at the closing costs. What would you give the advice of someone like with the down payment closing costs, like how they work? Because of course some of these loan types you gotta have and show right.
Yes. So the easiest way to break that down is pretty much when anything is just like buying a car or buying anything, it's going to be taxed on top of that. Okay. So what I do is just kind of say, for example, if someone's buying for numbers sake, $100,000 home, and then they're putting down 3.5%. So your loan amount is going to be that 96,500 for your actual loan amount. So that means you're bringing $3,500 for your actual down payment. But let's say that out of everything, your lender fees, your appraisal, all of those things come to another $3,000. So now you have $6,500 into that transaction instead of the $3,500. So now you're having to bring that $3,500 for your down payment plus the $3,000. So you're bringing $6,500 to closing to close on that transaction. The great thing about it is most times when you're dealing with a realtor like Asia and you're putting down earnest money, meaning you're saying that you do want this property, I want to move forward, I want you to take it off the market, I want you to hold this for me because this is the house that I want to get. You're coming with maybe $1,000, just throwing a number's sake out there. So when you get to closing, you're bringing $5,500 to closing instead of that $6,500 because you've already put $1,000 into the transaction. Okay. Now, also, if you have a great agent like Asia, you're negotiating the closing costs. Absolutely. So you say, hey, I would like for you, I want to buy this house, but my client needs that $3,000 to be able to offset the cost to bring to closing. So now you're back at that amount. So if the seller's paying $3,000 and you've already put down $1,000, then you're bringing just your $30,000 or $2,500 now because you already put down $1,000. So that's how the numbers start to decrease based on how much is being paid up front, how much is what they consider concessions, and what your total cost that you need to bring to closing. Okay. And then the gravy on top of that. Let's say, for example, you get down payment assistance. So your down payment assistance may cover all of that. So then most of the programs require you to put something to the transaction. So let's say you're at one of the down payment programs that require you to put $1,000 down. Okay. And then we're going to give you that $3,500. Then you're coming to the table with, guess what? No money. Because you've already put your $1,000 in, you were able to get down payment assistance, you were able to get the seller to contribute, and you put your unit into it. So that's how the numbers work as far as your cash to close. So always I let people know when you're buying a house, it's not just your down payment, it's closing costs as well. So negotiate all of that. Yes,
and you got to negotiate because I know we had one. I was able to negotiate closing costs. She received down payment. She's in the healthcare field, and we got to close. And she had to pay $27. So it was like, so like you can't even pay that in cash. But and then so I was very, very happy for her. But well, like $27. Okay.
Yes. Yep. So, you just can't get any money back. You just whatever you want to try to. My goal is to get you to bring as least as money to closing as possible.
Yes, and then it can be like if you're getting those funds, can it be tied back into the mortgage to utilize those funds to get the mortgage down?
Right. So, for example, in this the instance where if it's $100,000 and you put down $35,000, but the down payment assistance that you're getting is $10,000. So now you can take that mortgage down to $90,000 instead of $96,000 5, then you're going to bring it down to about $89,000.
Okay.
So your payments is based on your loan, not your purchase price. So your loan is where your mortgage payment.
Right.
So if it's lower, then your payments are lower.
Awesome. Yes.
Yeah.
Thank y'all so much for tuning in. Tune back in with us because we will have a part two with the roadmap to home ownership. We'll be right back. Thank you for tuning in with the R in Real Estate. Thank you to our sponsors, R.S. Johnson Legal, Real Estate Closing Firm, Will and Probate, Kelvin Pearson with State Farm Insurance, Fleda Paul with Diamond Residential, Gerard Williams with G2L Residential and Commercial Inspections, and Adhesia with AR the Brand.